Welcome to Woods of Stardon. This is CH. I will be covering the Janus Henderson Balanced Fund in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the BlackRock Systematic Global Equity High Income Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. Janus Henderson Investors was formed in 2017 through a merger of Henderson Global Investors and Janus Capital Group. Henderson Global Investors was founded in 1934 and had been more active in Europe and Asia, while Janus Capital Group was founded in 1969 and had been more active in US. The merger was therefore a combination of the investment expertise and market coverage of both firms. Janus Henderson is a public company that is listed on the New York Stock Exchange. Janus Henderson today manages over $480 billion of client assets through 350 investment professionals located in 25 offices globally. US clients cover about 2/3 of the business, while Asia Pacific is small at just 8%. The Henderson Global Investors branding used to be more popular in the region. However, the firm hasn't really been putting much effort in its Asia product offerings after the merger happened. Product category-wise, equity solutions take more than half of the firm AUM, while multi-asset solutions, which this fund falls under, is about 12% of the firm AUM. The Janus Henderson Balanced Fund is a sub-fund under the Janus Henderson Capital Funds plc fund family. The fund family is set up as an Irish investment company with variable capital or ICVC structure and is UCITS qualified. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The Janus Henderson Balanced Fund is currently co-managed by 3 managers. Their bios are readily accessible via the fund webpage, which is good for investors. From the bios, it appears that Jeremiah specializes in equities across multiple sectors and has been with the firm for the longest period since 1998 in Janus. Greg and Michael, on the other hand, specialize in bonds and are under the Core Plus team, where Greg is also the head of the team. Morningstar shows there have been quite a number of manager changes through the lifespan of the fund. Jeremiah is currently the longest serving co-manager since 2015, while Michael and Greg joined in co-managing the fund in 2019 and 2020 respectively. Hopefully, the current team will be stable going forward as manager changes can bring about different investment styles, which is not ideal for investors in terms of consistency of the fund strategy. The Janus Henderson Balanced Fund provides a short investment objective as well as a brief investment policy in its webpage and fact sheet. The objective states actually 3 things that are long-term capital growth, capital preservation, and balance using current income. It sounds a bit complicated, and I would interpret it as the main objective of the fund is capital growth, but achieved through prudent risk management to minimize unnecessary losses and to mix with bonds to reduce portfolio volatility. The investment policy provides clarity on the actual strategy of the fund. This is really a US-focused multi-asset strategy that has a flexible allocation between equities and bonds. Let's go through the prospectus for more details. The prospectus doesn't allow copy-paste, so I can't do my usual text highlighting here. In any case, the prospectus states clearly the allocation restrictions of the fund with more details than the investment policy in the webpage and fact sheet. The fund needs to have minimum 80% US exposure, with a max 10% that can be allocated to emerging markets. Equity allocations need to be in a range of 35% to 70%, while bond allocations take up the rest with 30% to 65%. Within the bond allocations, a max 35% can be allocated to high-yield bonds. The fund seems to be able to invest in derivatives for investment purposes, and there are no specific restrictions mentioned. We will see later if the fund discloses the actual usage of derivatives in the portfolio. The prospectus then clearly states the benchmark of the fund to be a composite of 60% S&P 500 index plus 40% Bloomberg US Aggregate Bond Index. So we can take this to mean that the long-term expected allocation of the fund to be around 60% equities plus 40% bonds. Additionally, it is clearly defined here that the fund has a performance target that is 1.5% per annum above the benchmark over any 5-year period. I think this is one of the very few mutual funds that I have come across that actually defines the return target so clearly, which is good for investors as we can easily find out whether the fund has achieved this intended target in its track record. This follows with a long paragraph clarifying that while the fund has a benchmark, the portfolio construct and underlying holdings are unconstrained by the benchmark. The actual asset allocation is also intended to be dynamic and flexible, according to how the team assesses the market conditions. The prospectus then provides a brief paragraph on the asset allocation approach and investment process of the fund, with some important information for investors to note. From the descriptions, it seems that the fund primarily focuses on its equity exposures, which has a core plus opportunistic allocation approach. Core equities are expected to be the more stable exposures for long term, while opportunistic positions should be more tactical or short-term in nature. The bond exposures are then used to help manage the volatility from the equity exposures, and are selected using bottom-up fundamental analysis. With this paragraph, it seems a bit strange to me why the fund has one equity manager and two bond managers in its fund manager team, instead of the other way around, when the investment process places a higher emphasis on the equity exposures. The last paragraph, which is a risk disclaimer, is actually funny. Multi-asset solutions have been widely advertised in the market to investors for many years as a single product to conveniently cover both equity and bond allocations, as well as to cover decent return and income stream. As such, it has been rather common to see these products being positioned as a main core holding in especially smaller retail investor portfolios. So this is the first time I'm seeing a disclaimer that states the opposite. The main Irish prospectus appears to contain more paragraphs than the Singapore prospectus. While most of the contents seem to be repetitive on the same points, there are some additional information available. For example, here it states that the equity positions look to be more based on bottom-up selection rather than via top-down allocations such as across sectors. This follows with some further elaboration on the bond exposures in the portfolio, where it seems that it is quite flexible in terms of the segments and markets the fund can invest in, from govies to corporates to preferreds to securitized assets to floating rate loans, etc., and without any additional constraints. The prospectus then reiterates that the fund mainly adopts a bottom-up selection approach, so there really isn't any allocation decisions made via top-down macroeconomic views. The last paragraph talks about the usage of derivatives in the portfolio for efficient portfolio management purposes only, so we should not expect any notable derivatives or structured product positions in the portfolio. There is a mention of the fund being able to take a max 100% leverage, though we will see later if there are any disclosures on leverage in the actual portfolio. The Janus Henderson Balanced Fund was incepted in 1998, giving it a long track record of over 25 years. Fund AUM at nearly $11 billion is a decent size, and there is plenty of room to grow given the US market is the largest in the world. Country breakdown shows the fund has about 96% US exposure, even though it is allowed to invest up to 20% outside of US. This suggests the fund managers currently find better investment opportunities within US, and therefore there is little need to diversify outside of US. Sector breakdown is the most useful here, as it shows both equities and bonds breakdown sorted in a nice manner. The portfolio currently has 63.4% equities and 36.6% bonds, which is very similar to the benchmark of 60% equities and 40% bonds. Comparing the equity sector allocation within S&P 500 index, we can see that the fund isn't significantly different from the benchmark index. There is just slightly more exposures in the fund in financials and healthcare, but nothing glaringly standing out. Bond sector allocation shows more differences via the benchmark index, that is Bloomberg US Aggregate Index. Taking reference from the iShares ETF that tracks the index, we can see the index is primarily US Treasuries and MBS. The fund on relative basis has less treasuries and instead overweights corporate bonds in both investment grade and high yield ratings. Equity market cap breakdown shows the fund is almost completely invested in large and mega cap stocks. There is typically no need to go for small cap stocks for asset allocation solutions, as the intent is to provide investors with a stable growth rather than high growth potential with increased volatility. Morningstar financial measurements show that the fund has significantly higher price and earnings measures compared to peers in the Morningstar category, suggesting the fund focuses more on growth-style stocks that have been doing well in recent years but are also getting expensive. On bond details, the maturity breakdown shows the fund has bond maturities spread across time periods but mainly in 3 to 10 year range. The resulting effective duration is rather high at around 6%, suggesting the managers are not too concerned about interest rate risk at the moment. Credit rating-wise, the exposures have only a small amount in high-yield bonds, so it is not really a concern. An average credit rating is still high at single A+. Morningstar shows the yield to maturity of the bond exposure is 4.87%. That is decently higher than the current US interest rate of 4%. Morningstar shows the fund currently has 64 equity holdings and 633 bond holdings, which is typical of multi-asset funds of this size. While the fund provides a top 10 holdings list, it doesn't really tell much, as most of the holdings are the mega tech stocks leading the S&P 500 index, again suggesting the growth bias in the equity allocation in the fund. The fund also comes with a sales flyer document that gives a nice summary on what the fund portfolio is about. I am only doubtful about the part where it says the fund focuses on large cap companies with quality, growth, and defensive characteristics. Given the mega tech stocks have grown so much in recent years and are rather expensive, I don't think they are really defensive positions. What is more interesting is the historical allocation chart that shows the asset allocation in the fund is very actively managed. We can see the overall allocations have changed significantly versus 10 years ago, when there were more corporate credits. Also visible is the very active adjustments in US Treasuries and agencies over time, presumably to manage portfolio volatility whenever there are increased equity market uncertainties. We will see if all these active management efforts translate to good performance later. Janus Henderson has one of the more complicated range of share classes, but we will focus on the A retail share class that is typically offered in the region for the Janus Henderson Balanced Fund. The fund was incepted in 1998, with only the A2 accumulation US dollar class available initially. There are a few different distribution policies, and the associated distribution US dollar classes were created in different years, presumably due to business demand. Most of the Sing dollar share classes were created in 2019, though the newest one was only recently created in July 2025. The fund is base currency in US dollars. The Sing dollar classes, however, come with both currency hedged and unhedged versions. We will compare the performances later. The fund offers several other currencies for retail share classes besides Sing dollars, though not all are offered in Singapore. The A classes are stated to have a management fee of 1%. Adding other expenses gives a total expense ratio or TER of 1.87% to 1.89%. This looks wrong, as it doesn't make sense for the other expenses to be so high. I suspect this 1% management fee doesn't include the potential trailer fees to be given to distributors, which is stated in the PHS as up to 50% of the management fees. In any case, 1.87% TER seems on the high side for multi-asset funds in the market. Some distributors may offer the institutional I share classes that have a lower management fee of 0.8% and TER of 0.88%. Now this makes much more sense, and it means the A classes should have a management fee of around 1.75% instead. I classes can have up to 2% subscription fees, though it is still the cheapest share class for the fund if you are able to access it, because the lower TER directly translates to 1% better returns yearly versus the A class. The Janus Henderson Balanced Fund provides the recent historical distribution data across its share classes in a PDF called Dividend Distribution History that can be accessed from the fund webpage. As seen, the information provided is pretty comprehensive, with the distribution amounts and annualized distribution yields all clearly stated. It is also important to note it shows here that the actual underlying portfolio yield net of fees as well, which is a really low 0.33%, that implies capital would need to be used to help cover for the distribution payout yields. With the data from the distribution history file, we've got here the annualized distribution yield of the different share classes. All the distribution classes of this fund have a monthly distribution frequency, as per denoted by the M in the share class. Let's go through the different distribution policies. A3 classes essentially pays a distribution yield based on the underlying portfolio yield, which is around 0.33% currently, gross of fees, which means the TER is added to the distribution yield. So that roughly translates to around 2.1% over time. As seen in the table, A3 doesn't have a smoothened payout policy, so the payout amounts and yields tend to fluctuate every month. A5 classes have a payout yield that is predetermined by the fund, and this has no relation with what the underlying portfolio yield is. In short, this is a yield that is defined based on what the fund thinks will attract investors to the share class. The fund appears to have set a 4% level for the A5 classes across currencies, and regardless if the share class is currency hedged or unhedged. Therefore, currency hedging costs will be factored in the NAV. A5 classes also seem to have a smoothened payout policy, as the monthly distribution yields tend to be at 4% per annum for the past year. Given the payout yield is notably higher than the underlying portfolio yield, it is inevitable for the A5 classes to use some capital to top up for the payout yield. A6 classes have a description that is nearly identical to A5 classes, with the exception of an additional word high, that indicates A6 classes will take a high portion of capital to top up to the payout yield, suggesting that A6 classes will have a notably higher payout yield than A5 classes. Indeed, the current payout yield of the A6 classes are at a pretty high 6.95%, that is almost 3% more than A5 classes. These A6 classes are created only in recent years, presumably to compete with multi-asset income products in the market. I don't really like such high payout classes as they deplete the capital left in the fund, which hurts long-term compounding growth. Here is a Morningstar chart comparing the A5 US dollar NAV versus total return. With a 4% payout yield, there is still enough returns kept in the capital, and therefore the NAV is still growing pretty decently. Here is the same chart but using the A6 US dollar class instead. With another 3% taken from capital to add to the payout yield every year, we can see the growth in the NAV over time is much slower. The sales flyer does talk about the A6 class, and explains that while the payout yield is set at a high 6 to 7% level, the fund has generated about 8% annualized returns for the past 5 years, so the A6 class is at optimal distribution levels to preserve NAV. What this suggests is that the A6 class is designed to pay out most, if not all, of the return gains in the fund. The past 5 years have generally been a bullish equity market though, So I wonder, how will the payout yields be determined when equity markets go through major market corrections? The Janus Henderson Balanced Fund sales flyer provides 10 calendar year performance and annualized performance across various time periods, comparing against its Morningstar peer group average. We can see that the fund appears to have outperformed the Morningstar peer group average quite comfortably across most time periods, so that's good. However, there is no benchmark data here, and remember, the prospectus does state the fund has a target return above the benchmark, so we should look at that instead to assess whether the fund has done well. The fund webpage provides 5 calendar year performance and annualized performance across various time periods instead. The balance index refers to the benchmark, that is 60% S&P 500 index plus 40% Bloomberg US aggregate index. The target return of the fund defined in the prospectus is benchmark plus 1.5% before fees over a 5-year period, whereby fees would be the TER of A2 class, that is around 1.9%. Using these numbers to calculate, the fund only managed to meet the target in calendar year 2021 and did not manage to meet the target across any annualized time periods. Therefore, the fund performance in consideration of its target return objective is actually not too good. It is actually not easy to find similar products to compare against, as there are hardly any US-focused multi-asset funds or ETFs offered outside of US. The nearest match I can find is the iShares Core 60/40 Balanced Allocation ETF that has about 66% US exposure. As seen in this chart, Janus Henderson Balance had performed quite close in the period of 2008 to 2018, but started outperforming thereafter as US markets led the rest of the world in terms of returns. Another popular fund that has adopted a different approach but giving a similar performance result is the Allianz Income and Growth Fund. That is a pure US strategy but with 1/3 US equity plus 1/3 US convertible bonds plus 1/3 US high yield instead. As seen in this chart, both funds have delivered similar performances most of the time, with Janus Henderson slightly better in 2024 and 2025. This shows there are multiple ways to achieve similar results in the investment world. Another option for investors is to try replicate this strategy using multiple products. Given the asset allocation is pretty straightforward, investors can potentially consider using a S&P 500 ETF such as CSPX and a US aggregate bond ETF such as IUAG. Investors who don't like the high exposures to US Treasuries can switch to a US-focused bond fund instead, such as PIMCO GIS Income. Here are the performance calculations, with the assumption that there is a rebalancing done at the start of each year. I think both the replication ideas give pretty decent and competitive results compared to Janus Henderson Balanced Fund, so they are probably worth considering for investors looking to build a US-focused multi-asset exposure. Investors who need some income can take out some of the returns as needed when doing the rebalancing exercise. Lastly, let's take a look at the Sing Dollar classes. Here are the A5 US dollars, A5 Sing Dollar Hedge, and A5 Sing Dollar Unhedged share classes. We can see the performances haven't been too different over the years, with the Sing Dollar Hedge class underperforming a bit more in the last 2 years due to increase in currency hedging costs. At the same time, the Sing Dollar Unhedged class also hasn't been able to outperform the US dollar class as a consequence of the movements of the currency pair. So there hasn't been much difference in performance of the Sing Dollar Hedge and Unhedged classes. With that, let's summarize our findings. Janus Henderson is a decently sized global fund provider with over 480 billion US dollars of AUM and is the result of the merger of two firms of long heritage. While multi-asset solutions is not a significant portion of the firm AUM, the Janus Henderson Balanced Fund is a flagship product representing US multi-asset solutions and comes with about 30 years of track record. While there have been some personnel changes in the past, The three co-managers of the fund have been stable in the past 5 years. The fund runs a flexible US multi-asset strategy. The main objective is growth to be achieved primarily via equity allocations through a core opportunistic investment approach. Bond allocations are mainly a supportive role to help manage portfolio volatility. The fund has a defined benchmark of 60% S&P 500 index plus 40% Bloomberg US Aggregate Bond Index. Additionally, the fund has a defined target return of 1.5% gross above the benchmark over a 5-year period. Having both a clearly defined benchmark and target return is good, so that the managers know what they need to achieve and investors know what to expect from the fund. There seems to be some confusion in the management fees stated. In any case, the TER of the retail A share classes of almost 1.9% looks slightly high. The fund launched the A6 distribution classes with high payout yields in recent years, but they look unnecessary, as the fund has a growth focus, and paying out all the gains doesn't help investors in terms of long-term compounding growth. The older A5 classes look good enough for investors who are seeking for some income from this fund. The fund performance, while decent compared to peers, doesn't seem to have met its intended target return in recent years. The managers will need to improve on this to make the fund more attractive. As such, it is currently not difficult to replicate the fund's performance using common ETFs or funds available in the market following the 60-40 asset allocation. In conclusion, I think the fund performance needs to get better and at least meet the target return for a start in order for it to be more attractive to investors. Otherwise, it currently doesn't look too worthwhile paying for the active management of the fund when the strategy and performance can be replicated easily. This concludes my absolutely biased comments on the Janus Henderson Balanced Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.